Welcome to this special live episode of Crypto in America. I'm here at the Federal Reserve Building in Washington, D.C. for the first ever Federal Reserve Payments Innovation Conference. And I'm here with the guy who put this entire thing on, Federal Reserve Governor Christopher Waller. Thank you so much for joining us today, Governor Waller. We're so excited. Yeah, we're so excited.
Looking forward to chatting.
I know. We've seen each other at a few conferences, and we're excited to kind of get into the details of the conference. And there's a lot of news to cover with you too. But I did want to start off by asking you, you are on the short list to succeed Chairman Jerome Powell. And I understand that you had an interview recently with Secretary Scott Bessent. Can you give us an idea of how that interview went? What goes into an interview for something as big as, chair of the Federal Reserve?
So, a lot of the discussion, as I mentioned before, was really just about economics, monetary policy, the Fed, the economy, even stuff on payments, the size of our balance sheet. These are kind of conversations I love. I can talk about this stuff all day long. So it was an hour and 45 minutes, and it went just like that.
Really?
It was so fast. But yeah, that was it. It was just a really, really good discussion. Scott asked a lot of good questions. And, I think I answered them okay because I haven't been thrown overboard on the ship yet. So,
do you want to be Fed chair?
If the president thinks I'm the best choice, then and if you ask me, I'll do it. But that's up to the president's side, not me.
Yeah. Well, let's go into the news we broke. Well, you broke actually this morning at the Fed's Innovation Conference. The skinny master accounts.
Yep.
I want you to give us an overview, but from what I understand, it's basically a new way of giving non-banks or fintech companies, stablecoin issuers, access to a master account without going the full Monty, basically, sort of a Fed master account light, if you will. Can you kind of explain to our listeners what that entails?
All right. So first of all, it's for eligible depository institutions. That's in the language of the Federal Reserve Act. Mm-hmm. So it's not just fintech firms or stablecoin issuers. You have to have certified kind of a bank charter. So like the Speedy accounts in Wyoming or the trust charters that a lot of the firms are applying for now, they then are eligible to request a master account. So that's the set of, you have to go through these processes to get a bank charter to ask for a master account. Now at the Fed, we have a tier 1, tier 2, tier 3 risk category for these various bank charters. If you're in 1 and usually 2, you get this full-fledged, full-service, I like to joke, call it the luxury master account. And then the issue is with the tier 3s, do you just say no or yes? And then you give them the full thing. So my thinking on this was like, why don't we tailor this structure of the master accounts to fit the risk profile of the bank charter? So, and then by doing so, you kind of control the risk that we face when we issue these things. So what I had in mind was, now it's kind of a prototype. It was just my way of framing this to get the conversation going and thinking about it. These would be accounts that don't pay any interest, unlike a true master account, reserves at a bank. There would be possible caps on the size, because if it's truly designed to be for payments, that's why, what is the purpose of this account? What do you want it for? Mm-hmm. If it's mainly for payments, which a lot of these firms really, that's what they want to do, certainly a stablecoin issuer, then, okay, tell me kind of what your average daily volume is that you need to run through the payment rails. Now, they're also 24/7, so the money has to kind of always be there. They can vary it time of day if they need to for liquidity management. But the idea is there's a cap that controls how much exposure we have, size of my balance sheet, which a lot of people get kind of bent out of shape about. So that would be one. And then you would not be eligible for what are called daylight overdrafts. So during the day, if you're a bank and your account goes negative, we provide you the credit to make sure that the payment gets made. And then at the end of the day, you have to settle up. With these accounts, if you hit 0, payments will be rejected. So there's no credit extended from the Fed. Again, there's no discount window. So the whole idea is there's a lot of services. If you're really just a payment firm, you don't need all this other stuff. And so therefore, it makes us a lot easier for us to control the risk that the Federal Reserve banks and the payment system are exposed based on the characteristic of your bank charter.
Got it.
So that's kind of the idea, to kind of tailor these things. And then we don't have such a big decision of, if you're in this tier 3, do we give you the full gold medal or do we say, here's a bronze? You know, you really need the bronze. That's good enough.
Leveling the playing.
You're just kind of leveling it. We're kind of matching the risk profile of the bank to what we give them access to minimize our risk. And that's what we weren't doing before. So that's why I think it's a pretty good innovation. We'll kind of see where it goes.
You mentioned a prototype. When can we expect guidelines on something like this?
Well, that's the thing. We have to kind of sit down and think about what do we want to do. We'll get some feedback. I'd like to get some feedback from the industry about aspects of this, problems with, I mean, even within the Fed, my colleagues who are presidents of reserve banks have already given me a bunch of feedback on why we should not do X or why we should do Y. And that's the kind of stuff we have to sort out. The other thing is just technically, can we do these things like cap the accounts, monitor it, fully all day long? How do we ensure that the money stays in overnight and isn't like lent out in the Fed funds market? These are more technical things. We've never done it, so I have to kind of see what the technical expertise. But the idea is not to take 2 or 3 years to do this. The idea was if we could do this in a year, I think that'd be fantastic.
Yeah, and this is a big deal for companies like Kraken, Custodia. They've been seeking master accounts for a long time now. How do you see something like this affecting, Custodia case?
Well, that would be the thing. We could look at both Custodia, Kraken, circles applied to the trust charter, and we can kind of look at the structure, see what your thing. One of the things we're always concerned about is AML and money laundering and things. Do you have the proper controls in place? How are you going to monitor this stuff? How can we do it? Are the regulators going to have the right models? And then we can say, look, because we're limiting the risk you pose to us, we'll have a much faster and quicker approval process, easier and quicker approval process. We won't take 6 years and have to go to court. That's my hope. That would be the goal of trying to do this.
Got it.
Yeah.
Guys?
And then I also want to chime in here, Governor Waller, thank you so much for taking the time to join us with Eleanor in person and me and Gerald virtually. Fortunately, we're just, on the go, so we couldn't make it. But, we're seeing more crypto companies seek out federal trust charters. Just last week, Governor Barr warned about the risks of the trust charter in the context of stablecoins. Do you believe that trust regulation is the same as banks? And should they be able to call themselves banks?
Well, this is kind of what was concerning to me, is that everybody was trying to manipulate the system to somehow get something that's an eligible bank and depository institution. So it's like I'm trying to come in the back door, the side door to get a master account. I personally would just say, look, come in the front door. You want to do X, tell me what X is in a payment, and then we'll construct a master account that would satisfy that. And if you don't behave, quote unquote, we could just cap the thing at 0, and that would be the end of it until you kind of get your performance back up to snuff, or any of your other compliance issues have to be put in place. So that was kind of what I wanted to do, was avoid everybody doing these kind of backdoor bank depository charters. And then we have to worry about some regulator that's looking at it. And that was what I was trying to avoid. And hopefully this is just a way, instead of dealing with all that, come in, you really want to do payments, here's the account, very limited. We might start small at first, see how you're running it, see how you're managing it, and then we can kind of think about expanding out. But that's really the idea, is to kind of come to some kind of compromise over this and get people to come in the front door. Just, what do you want it for?
Right.
If it's just payments, that's fine. We can think about a very simple way to do a payment account. And that's why I prefer to call it a payment account, but skinny master account seems to be what people understand.
I like it.
Yeah. Yeah. Governor Waller, it's obviously really good to see the Fed lean into innovation. It's such an exciting time for the industry and both in financial technology overall. We're obviously a pro-America, podcast here. And in the past, I want to switch gears a little bit. You've been critical of Europe about regulating emerging technology in a way that really killed kind of innovation in the cradle, right? I think they're sort of baby with the bathwater. Many in our industry have been critical that the Fed under the previous administration was guilty of some of the same sort of behaviors. You were on the board at that time. Why do you think the industry was so vulnerable to things like debanking, and what we've kind of deemed Operation Choke Point 2.0? What's your take on that period in history?
Well, I just think that, I mean, I had to have a different view of it. So I always try to, and if you've heard me do this example, please bear with me, but it illustrates the point very easily, which is whenever there's a transaction, you're buying something and you're paying for it with something. And then there's a technology for doing that transaction. And then there's a technology that records the history of that transaction for proof of ownership. So I go to Whole Foods, I buy an apple, I pay with $1 in my bank account, I take my debit card, I tap it on a reader, and it spits out a receipt. With a crypto object, you're going to buy a crypto object, you pay for it with a stable coin, you use a smart contract to do the transaction, you record it on a blockchain. If I took out the word crypto in the first stage, the last two things are just technology. They're just technologies for how to conduct a transaction and how to record the transaction. There's nothing evil or dangerous about it. But because it got tied up with this word crypto, this object that you were buying, it all became evil. I don't want to mean that literally, but I mean, it became dangerous, suspicious, and we just couldn't have it. And I used to argue, look, get the word crypto out of it. This is just technology on the other side. Let's just think about the technology, which was the point of this conference today. Let's just think about the technology stuff. I don't really want to talk about the assets that are out there in the crypto world that people are talking about. So that's been my position for a long time. And just with the change in the administration, the change in attitude towards the whole thing, it was just a good time to say, for the Fed, let's, again, put the crypto stuff aside, other than stablecoins, which I like as a payment instrument. Let's just talk about technology and how it's going to be used in the DeFi world, how it's coming into TradFi, and then just work together. That's kind of the theme that I'm getting on all the payments conferences. Both sides are increasingly, how do we work together and use this technology to make the payment system better, faster, cheaper?
Bitcoin might sound complicated, but the Gemini credit card makes it simple. Use it like any credit card. Buy lunch, gas, or your weekly groceries, and you'll earn up to 4% back instantly in Bitcoin or one of over 50 other cryptos straight to your account. No annual fee, and right now you can grab a $200 Bitcoin intro bonus. It's the easiest way to start building your Bitcoin stash. Go to gemini.com/CIA to learn more. Terms apply.
I mean, with the Genius Act, it gives the Fed and other banking regulators a lot of discretion in how it's implemented, kind of going back to the point we were discussing before. So I'm curious, how do you kind of balance the priorities of, protecting the banking system, making sure innovation isn't stifled, while also ensuring stablecoins actually work as a payment tool?
Well, there's a couple things in the Genius Act. One is it gives banks the ability to issue their own stable coins. So the way I always try to explain it to people is, most of the banking regulation, the regulators, the OCC, the FDIC, the Fed, they're looking at how do we let the banks issue a stable coin in a safe, sound, way that doesn't threaten financial stability. Once that's done, the stable coin is just a payment instrument. And then it comes over to me. I'm the payments oversight governor. So it's like checks or ACH or any other kind of FedNow payment, real-time payment. That's all under my purview. Even though the banks are doing it, it comes under the payments oversight. So I need to be involved to understand kind of what the regulations are going to do, how this affects payments, and things like that. In the Genius Act, there's also the ability for non-bank financial intermediaries to issue a stable coin. Now, there's nothing in the Genius Act that says you get access to a master account. And I just explained that the Federal Reserve Act says you have to be an eligible depository institution. But these non-bank financial intermediaries are going to be payment firms. And a lot of that stuff is going to potentially impact me through the payment system and the payment rails. So that's kind of how I think about it, is there's the whole bank stuff and then there's the non-bank stuff. And I'm more involved in the non-bank stuff and trying to make sure that the regulation, everything gets done right that way.
The legally eligible. Now, is that the Wyoming Speedies and companies listed under the OCC or regulated under the OCC?
Well, that's the thing. He's from what I understand, I'm not a lawyer, but from what I understand, these are legally eligible. Now, they can request. It doesn't mean you get one. Let's be clear. It just says you're able to request. If you're a non-eligible deposit, you can't even ask. Mm-hmm. So that's the fundamental difference.
The Fed's discretion?
giving it to you is at our discretion. And right now, that's as I understand it, that's a custodia case, whether we have that discretion or not.
Right.
But even if custodia were to win, we have the discretion to put some limits on how that account is used. And that was the question I raised with the lawyers, like, can we do anything with the account to control our risk exposure if we gave these out? And the answer is yeah.
Yeah.
So then I thought, well, then that's less of a problem than the full scale, full service, full credit extension to these banks. We can just limit what services we give you. And if you really are doing this really to just do payments, well, we can fix that easily. We don't need you don't need the full size luxury model master account.
The Bentley of master
You don't need
accounts.
the Bentley. You just get the nice Ford,
Nothing wrong with a Ford.
Exactly. That's right. That's my point. Right?
It'll get you where you're going. Yeah. Governor, I want to ask about the topic you mentioned, stablecoins, obviously top of mind for a lot of folks right now. Genius, of course, is being treated as settled law, which it is. But, of course, there's some folks who want to take another look at it through the form of whether it's market structure or other avenues. Our industry has said that, you should be able to pay some kind of reward or yield on the actual T-bills and money market funds that you're holding to fund. You should be able to pass some of that on to customers. Banks have kind of argued that it may cause, one, commercial deposit harm, and then two, the other thing that we always see is this argument about FDIC insurance and, the stability of the financial system. With that, with the Fed's role in terms of helping, American small businesses, families, process transactions and find sort of liquidity, what effects on sort of the overall economy do you think stablecoin yield could have if it was able to be passed on versus kind of keeping it the way Genius outlined it right now?
Well, like I said, I think of stablecoins as a pure payment instrument. It's not an investment vehicle. It's not a time deposit where you're holding it to earn interest. That is not, in my mind, no different than currency, right? You're not holding currency for its yield. You're using currency historically as a payment instrument, and that's how I think of stablecoins. They're just a substitute for U.S. dollars, right? So if they're going to be a substitute for a U.S. dollar, then have the same attributes, which is non-interest bearing. Now, what I always tell people is you can take a $20 bill, go to the bank, deposit it, and earn interest. But somebody's still got to hold the $20 bill, right? It doesn't disappear. It doesn't go into thin air. So with the stable coins, it all hinges on how you do this rewards or compensation. If it's in a sense, it's like I transform the stable coin into a different asset that pays interest. That's like putting it in the bank. And then somebody's holding the stable coin on the other side that doesn't pay interest. If it's just another way to say, look, you own the stable coin, but we're going to pay you something called rewards instead of interest, and then it's kind of skirting the spirit of the law. That's kind of my view. If Congress wanted to let you pay interest, they should have just said, let you pay interest. So trying to backdoor it is a little funny. Now, on the other hand, the banks have done this did this decades ago. Back in the 60s, you had what was called Regulation Q. You could limit what people could earn on their savings accounts by law. So what did banks do? Well, come in, you put some money in, we'll give you a toaster. We'll give you some new dishes. So even the banks did this back in the 60s. I remember my mom getting stuff from the bank just that way. So it's not like it's something new that hasn't been done. It's just, it creates this tension between it's not supposed to bear interest, and you're kind of backdooring the requirement on paying interest. And, at that point, it's not up to me to decide whether that's up to Congress to sort that out.
Yeah. Sorry, Ellie, I was going to ask just a quick follow-up on that, just on the historical sort of nature of payments. Governor, would you consider an argument around sort of like rewards for credit cards, the process payments, like an applicable argument here? Do you think the products are different enough that maybe that doesn't apply? Like if, my Delta Sky Miles card, right? Like what do you think?
Yeah, remember, it's a credit card.
Right.
It's credit extension. And there's a couple of aspects of that are very different than a stable coin giving you interest just to hold on to it. So that's what I mean. That's why I don't want to think about paying interest on these payment accounts. It's not supposed to be an account for somebody to hold stablecoins and earn interest. It's supposed to be a payment. Payments are typically a fast, high velocity thing. You're not holding it to earn interest. So that's kind of my thinking on it. Like I said, it's not my job to determine. It's whether Congress wants to do something to either prohibit or do whatever. But well, anyway, those are my thoughts.
Would you say the banks have a point then in potentially, if yield was to be approved or, this ended up happening, that could be like a mass reduction out of like the credit and like the mortgage market?
Yeah, I mean, this is kind of a funny thing because I always have this conversation. There's always this talk about disintermediating the banks. So let me just walk through the process for you. I want to buy a stablecoin. I go to stablecoin issuer. I give them a claim on my checking account. They give me the stablecoin. I give them the claim on my checking account. What are they going to do with that claim? It's only a value if they put it back in the banking system. Just like if I go buy anything and I give the Whole Foods, I give them a claim for the apple on my bank account. The claim's only good to them if they put it back in the bank. So that's the thing. The stuff always ends up coming back into the banking system because it's a claim on the banks. So I took it out. They redeposit it. You can disintermediate a bank, but you can't disintermediate the banking system. Now, if the stablecoin issuer comes back to my bank and says, here's $20, give me $20 worth of treasuries, so their assets go down and their liabilities go down, then you would disintermediate the banks. But that's the bank's choice of whether they want to reduce their treasuries and give it to you. You don't have any claim to demand treasuries when you redeem my claim. That's not part of the contract on my deposit account. You don't get to go to the bank and say, I want some treasuries. They'll say, no, you get $1. Here's what you get.
Want some gold bars.
Yeah.
I know we're going to wrap up fairly soon, but just to bring it back to today and the conference, we talked a lot about stablecoins, a lot about AI and payments, tokenization. I've also heard you talk about zero knowledge proofs, which, to be honest, I never thought I would hear a Fed governor talk about.
Yeah.
You mentioned this on stage fairly recently. I mean, can you talk about, what you guys are doing a little bit of research to into the Fed? Like, what about zero knowledge proofs are you researching and thinking about? What kind of, things around that can we expect, to come out of the Fed? Yeah,
we have a pilot group that does actual hands-on keys kind of research on all this technology. Like, how would we use this technology in how we do payments? Mm-hmm. And one thing that we thought about with, the zero knowledge proof or the same kind of concepts is like identity. Mm-hmm. Well, we talked about this conference today. If I have to turn over all my identity to you, there's no way to get it back. So how do I prove to you who I am without actually giving you all my identification? That's kind of what zero knowledge proofs do. It's allowing you to prove something without having to give you this immediate direct evidence. So, for confidential privacy and things like that, security of your details, because we handle payments too, just like everybody else. Mm-hmm. That's kind of one of the things we're thinking. How do we actually do verification of identities for payments or institutions with payments without actually having to take all their information? So this is a thing we're exploring in a lot of ways. We're looking at how do we process stables if a bank comes to us and says, I want to process a stablecoin payment through FedNow. How do we do it? Stablecoins are just a different messaging system. They use hash locks, well known in crypto, but it's not in the standard banking rails. But it's just a messaging system. And so we've already figured out a prototype how we would process stablecoin payments across FedNow. It's a prototype, it's an idea, but we haven't actually put it in practice. But if we keep moving down this road, then that's something we have to be able to. I told the team last spring when Genius was being debated, look, this is probably going to pass, and there's a good chance we're going to have to do this. Mm-hmm. So how do we do it? And they went out and boom, it was done.
Work at the speed of tech.
Speed of my orders.
There you go.
Governor Waller, I think we would be remiss if we didn't bring up Bitcoin as well. And as you know, gold is trading near all-time highs, and so is Bitcoin. And the two are often seen, especially in this industry, as safe havens and are trading at these highs, kind of reflecting maybe the market sentiment towards the economic uncertainty, if that's a term I could use, right? While the geopolitical outlook may be hard to predict, how do you kind of feel about your personal outlook towards Bitcoin?
Look, I have always argued that Bitcoin was going to end up being something like electronic gold. It's a store of value. It promises no return. You buy it and hold it for some appreciation. That's exactly what you do with commodities like gold. That's it. There's nothing wrong with it. It has a positive price. It doesn't have any fundamental value. I don't think gold has really any fundamental value either, but.
Hey now, hey.
Hey, you're going to make some jewelry, put it in your teeth. I mean, come on. Given that stuff, you're not going to pay $4,000 for that. There's something else. But in economics, we know you can have these type of assets that are belief equilibrium, that I'll pay this because I believe someone will pay me that later. Even though there's no real, it's just the belief that somebody else would pay you. So that's how I kind of think about gold. That's how I think about Bitcoin. And I don't have any dog in the fight. I don't care. People can hold this stuff. I've made this joke before, but people buy expensive baseball cards, what's the fundamental value of a baseball card? It's a lousy picture on a piece of cardboard. You can't tell me that's really useful for anything.
Depends who it is, yes.
So, but in terms of the price, we've seen this with metals before. When I was in college, there was a huge run up in gold, and gold was just going to keep going forever. And guess what? It came way back. So this is the thing with these kind of commodities. They'll have these bull runs and then they have these crashes. And so I kind of think maybe right now there's concern about geopolitical sensitivity. There's buying of gold by central banks, worried about sanctions. There's lots of reasons people are doing this, but it's not necessary. And then there's always the momentum trade. I'll buy it if I think somebody buys it for me. And as long as I sell it before it crashes, that's okay. Those trades always tend to happen. So, let it run. If it crashes, some people lose their wealth. It's not my job to protect people's wealth, as I say that all the time. So,
Last question before we wrap up for real. Today's conference is all about getting recommendations from industry on how to implement sort of, the future of the Fed, right? What was the biggest takeaway that you learned from today?
I mean, the biggest takeaway is I do believe that the technology that was this forbidden evil, I keep saying, I shouldn't say that word, but this forbidden technology is now at the forefront of what every traditional firm is looking at. The tone, when I was at Sibos a couple of weeks ago, I met with a roundtable of about 25, 30 payments firms from around the world and asked, what's the top of mind issue? Every one of them said either tokenization, stablecoins, or digital assets. 3 years ago, that would have been at nobody's top of mind. So the speed at which this stuff is coming into the discussion in the world and the payment system is pretty fascinating. Now, it's still in its infancy. There's some issues with things, but the tone of the conversation has gone from like 7, 8, 9 years ago, which is, hey, dude, we're gonna take your job, we're gonna drive you out of business. It's now become, hey, we're gonna have to work together. How do we make things work? How do we have synchronization across these different rails and payment systems? There's been a massive cultural change in both the DeFi world and the TradFi world, thinking of this stuff and trying to move together and make things better.
Awesome.
That's what I took away.
Great takeaway. Well, Governor Waller, thank you so much for joining the show today. We really appreciate the time. And signing off here from Washington, D.C.
Our course field. Thanks, guys.
See y'all.